Imagine turning a simple stock trade into direct ownership of the world's most talked about digital gold, but without the hassle of wallets or hackers. That's the power of spot Bitcoin ETFs. But wait, in 2026, they're facing massive outflows, over $4.5 billion gone. Stick around to uncover why this beginner-friendly investment is still a game changer and how you can get in safely. Hello, everyone, and welcome to Joseph Markets, your go-to channel for all things finance, where we break down complex topics into simple, actionable insights. I'm Joseph, your host, and today we're diving deep into one of the hottest topics in the investment world: spot Bitcoin ETFs, explained for beginners. If you're new to crypto or just curious about how to get exposure to Bitcoin without all the tech headaches, this video is for you. We'll cover everything from the basics to the latest 2026 updates, with real facts backed by reliable sources. According to the U.S. Securities and Exchange Commission, spot Bitcoin ETFs were approved on January 10, 2024, marking a pivotal moment in crypto integration with traditional finance. But first, a quick note. All the information here is based on verified sources to ensure 100% accuracy. For more true news and correct advice like this, make sure to like this video, subscribe to Joseph Markets, and drop a comment below saying Spot ETF Guide. It helps the channel grow and keeps you updated on finance trends targeting the USA audience. Let's jump in. To keep you hooked, imagine this. Bitcoin has surged over 10,000% in the last decade, but accessing it safely was a nightmare until spot ETFs came along. Stay with me as I explain why this could be your entry point. What is Bitcoin? The foundation. Before we talk about ETFs, let's start with the star of the show: Bitcoin. Bitcoin is a digital currency, often called digital gold, created in 2009 by an anonymous person or group known as Satoshi Nakamoto. It's decentralized, meaning no single entity like a bank or government controls it. Instead, it runs on a technology called blockchain, which is like a public ledger recording every transaction ever made. As per Wikimedia's Bitcoin page, Bitcoin is the first decentralized cryptocurrency, with its white paper published in 2008. Why does this matter for beginners? Think of Bitcoin as money that's borderless and inflation-resistant. Unlike the US dollar, which can be printed endlessly, Bitcoin has a fixed supply of 21 million coins. That's it, no more. This scarcity is what drives its value. In simple terms, it's like owning a piece of rare art that everyone wants. But Bitcoin isn't just money. It's an asset class. People buy it for speculation, as a hedge against inflation, or even for everyday payments in some places. For example, companies like Tesla and Microsoft have accepted Bitcoin at times. According to CoinDesk, over 15,000 businesses worldwide accept Bitcoin as payment as of 2025. To retain your attention, here's a teaser. Bitcoin's price has been volatile, from under $1 in 2010 to over $100,000 in 2024 peaks. But how do ETFs make this ride smoother? We'll get there soon. What is an ETF? Breaking it down now, let's shift to ETFs. An exchange-traded fund, or ETF, is like a basket of investments you can buy and sell on the stock market, just like a stock. It's designed to track the performance of something. Could be stocks, bonds, commodities, or, in this case, Bitcoin. Investopedia defines an ETF as a type of security that tracks an index, sector, commodity, or other asset, but can be purchased or sold on a stock exchange the same way as a regular stock. For beginners, picture an ETF as a mutual fund's cooler cousin. Mutual funds are bought at the end of the day at a set price, but ETFs trade all day long, giving you flexibility. They're popular because they're low cost, diversified, and easy to access through your brokerage account. No need for fancy setups. Why are ETFs a big deal? They democratize investing. Before ETFs, accessing things like gold or oil was complicated. Now, you can own a piece with a click. The same goes for Bitcoin ETFs. According to the ETF database, there are over 3,000 ETFs in the US alone, managing trillions in assets as of 2025. Hang tight. Next, we'll combine these two. What makes a spot Bitcoin ETF special? Defining spot Bitcoin ETF. The core explanation. A spot. Bitcoin ETF is an ETF that directly holds actual Bitcoin in its portfolio and tracks the current, or spot, price of Bitcoin in real time. Unlike other products, it buys and stores real BTC, so the ETF's value mirrors Bitcoin's market price closely. CoinGecko explains that a spot Bitcoin ETF is an exchange-traded fund that directly holds actual Bitcoin as its underlying asset, providing investors with exposure without needing to manage the crypto themselves. Why spot? Spot means the immediate price, not future predictions. The ETF buys Bitcoin on the open market, stores it securely with custodians like Coinbase, and issues shares that represent a fraction of that Bitcoin. You buy the shares and voila, you're exposed to Bitcoin's ups and downs without touching a wallet. For beginners, this is huge because it skips the crypto exchange drama. No KYC hassles, no forgetting passwords, no hacking worries. It's all regulated by the SEC, adding a layer of trust. As stated by NerdWallet, spot Bitcoin ETFs hold a large amount of Bitcoin directly, similar to how a spot gold ETF holds physical gold. To keep you engaged, consider this. Since approval, these ETFs have held over 1.29 million Bitcoins, worth billions. But what's the history behind this? Let's travel back in time. History of spot Bitcoin ETFs. A decade-long journey. The road to spot Bitcoin ETFs was long and bumpy. It started in 2013 when the Winklevoss twins, of Facebook fame, filed the first application for a Bitcoin ETF. The SEC rejected it, citing concerns over market manipulation, fraud, and lack of investor protection. According to the SEC's historical filings, the Winklevoss Bitcoin Trust was denied in 2017 and again in 2018. Fast forward to 2021, the SEC approved Bitcoin futures ETFs, which use contracts betting on future prices, not actual Bitcoin. Products like ProShares Bitcoin Strategy ETF, BITO, launched, but they had issues like contango, where future prices are higher, eating into returns. Bloomberg reports that futures ETFs faced performance drag due to rolling contracts. The turning point came in 2023 when a court ruled in favor of Grayscale, forcing the SEC to reconsider. On January 10, 2024, the SEC finally approved 11 spot Bitcoin ETFs and trading began the next day. This was massive. First-day volume hit $4.6 billion. As per Chainalysis, this approval marked the most successful ETF launch in history. In 2025, things evolved. In July, the SEC allowed in-kind redemptions, meaning funds can swap Bitcoin directly for shares, boosting efficiency. Options trading on some ETFs also got the green light. CoinGecko notes that under new SEC Chair, Paul Atkins, these changes signaled a crypto-friendly shift. Now in 2026, we're seeing challenges. Spot Bitcoin ETFs have experienced 6 weeks of outflows, totaling about $4.5 billion year to date. Yahoo Finance reports that BlackRock's IBIT and Fidelity's FBTC led the exits with over $2.1 billion and $954 million, respectively. Reasons? Macro uncertainty, like inflation fears and shifts to safe havens like gold. Despite this, net inflows since launch are around $54 billion, with total assets near $85 and $94 billion. According to so value data compiled by Bloomberg, this is the weakest year since launch but structurally bullish long-term. Why does history matter for beginners? It shows resilience. Bitcoin survived rejections and is now mainstream. Teaser. But how do these ETFs actually operate? Let's break it down next. How spot Bitcoin ETFs work step by step. Let's demystify the mechanics. A spot Bitcoin ETF starts with the fund sponsor like BlackRock, buying Bitcoin from exchanges or holders. They store it in cold storage, offline wallets to prevent hacks, managed by custodians. Investopedia describes that registered custodians manage secure digital vaults, often using cold storage. The ETF then issues shares based on the Bitcoin held. These shares trade on exchanges like NASDAQ or NYSE during market hours. The price is pegged to Bitcoin's spot value, calculated using indices like the CME CF Bitcoin reference rate. As per CME Group, this rate is a daily benchmark based on transactions from major exchanges. Market makers ensure liquidity. They buy and sell shares to keep prices in line. If demand rises, More shares are created by delivering Bitcoin, in-kind creation. Redemptions work the same way in reverse. This minimizes tracking error, unlike futures. CoinGecko highlights that in-kind redemptions approved in 2025 reduce costs and improve tax efficiency. For beginners, it's like buying Apple stock, but for Bitcoin. You use your brokerage app, place an order, and own shares that rise-fall with BTC. No 24/7 trading, but that's a pro for some. Avoids overnight surprises. NerdWallet explains that ETFs trade only during standard hours, exposing to gap risk, but providing familiarity. Retention hook. Sounds easy, right? But what are the benefits? Coming up, I'll list them with real examples. Benefits of spot Bitcoin ETFs for beginners. Spot Bitcoin ETFs shine for accessibility. First, convenience. No need for crypto exchanges or wallets. Buy through Vanguard, Schwab, or Fidelity, even in IRAs for tax perks. CoinGecko states that ETFs allow exposure in tax-advantaged accounts like Roth IRAs, where gains can be tax-free. Second, regulation. SEC oversight means transparency, audits, and protections. No unregulated platforms. Investopedia notes regulatory rules ensure investor protection, unlike direct crypto buys. Third, liquidity. Trade like stocks with tight spreads thanks to market makers. NerdWallet emphasizes high liquidity as shares change price throughout the day. Fourth, diversification. Add Bitcoin to your portfolio with low correlation to stocks, bonds. A 5% allocation could boost returns. As per CoinGecko, Bitcoin's historical low correlation improves risk-adjusted returns. Fifth, lower risks. Custodians handle security with insurance. BlackRock's IBIT literature mentions secure storage via Coinbase. Real example, since launch, ETFs like IBIT have grown to $86.9 billion AUM by mid-2025, CoinGecko data. In 2026, despite outflows, they're still a gateway for institutions. But nothing's perfect. Next, the risks, so stay tuned. Risks and downsides. What beginners must know. Volatility is king. Bitcoin can swing 10% in a day. ETFs don't dampen that. If BTC drops, so do your shares. CoinGecko warns that high-risk tolerance is needed for substantial losses. Fees. Expense ratios from 0.15%, Grayscale Mini to 1.5%, GBTC, EAT returns. NerdWallet lists fees for all ETFs. Tracking error. Shares might not match BTC perfectly due to fees or timing. Investopedia explains deviation from the reference rate. Custodian risk. Most use Coinbase. If hacked or bankrupt, delays could occur. No FDIC insurance. NerdWallet highlights systemic risk from concentration. Market hours. No 24/7 trading, so weekend BTC moves cause gaps. The Motley Fool notes this difference from direct Bitcoin. Regulatory changes. Evolving rules could impact. SEC Chair Gensler's 2024 statement emphasized Bitcoin risks. In 2026, outflows show sensitivity to macros, like rising interest rates pushing money to gold. Yahoo Finance attributes 4.5B outflows to de-risking. For beginners, start small. Dollar cost average to mitigate volatility. Teaser, curious about futures versus spot? Let's compare. Spot versus futures Bitcoin ETFs. Key differences. Futures ETFs like BITO use contracts predicting future BTC prices. They don't hold Bitcoin, leading to contango costs when rolling contracts. Investopedia says futures settle in cash, with rolling, dragging performance. Spot ETFs hold real BTC, offering direct exposure with less error and no expiration worries. CoinGecko contrasts that spot is more efficient, avoiding derivative costs. For beginners, spot is better for long-term holding. Futures suit short-term bets. The Motley Fool recommends spot for direct tracking. Example, BITO has higher fees, 0.95%, and underperformed spot during rallies. Per NerdWallet, strategy ETFs deviate more. Now, let's list top ETFs in 2026. Top spot Bitcoin ETFs in 2026. Picks for beginners based on AUM, fees, and performance. iShares Bitcoin Trust, IBIT by BlackRock, 0.25% fee, largest with 87B AUM. Secure, trusted. The Motley Fool calls it the best for 2026 due to BlackRock's backing. Fidelity Wise Origin Bitcoin Fund, FBTC. 0.25% fee, 24B AUM. Great for Fidelity users. CoinGecko ranks it high. ARK21 shares Bitcoin ETF, ARKB. 0.21% fee. Innovative with ARK's tech focus. The Motley Fool lists as affordable. Bitwise Bitcoin ETF, BITB. 0.20% fee, crypto specialist. NerdWallet notes low fee. VanEck Bitcoin Trust, HODL. 0.20% fee, waived temporarily. NerdWallet details promotions. Grayscale Bitcoin Mini Trust, BTC. 0.15% lowest fee. The Motley Fool praises affordability. In 2026, watch outflows. iBit lost 2.1B, Yahoo Finance. For beginners, start with low-fee ones like BTC or BITB. Retention. How to buy. Step-by-step next. How to invest in spot Bitcoin ETFs. Beginner guide. Step 1. Choose a brokerage. Robinhood, TD Ameritrade, or E-Trade offer them. NerdWallet suggests brokers with zero commissions. Step 2. Fund your account via bank transfer. Step 3. Search the ticker, e.g., iBit. Step 4. Place order. Market for immediate, limit for price control. Step 5. Monitor in your portfolio. In IRAs, use for tax benefits. CoinGecko explains Roth for tax-free gains. Tips. Diversify. Don't invest more than 5 to 10%. Dollar cost average. Investopedia advises against all-in due to volatility. First-time expectations. Trades during hours. Expect fees. The Motley Fool warns of differences from direct BTC. Impact on the market. What ETFs mean for Bitcoin? ETFs validate Bitcoin, boosting adoption. Post-approval, BTC rose 160% to all-time highs. CoinGecko reports. They increase liquidity, reduce premiums in older trusts like GBTC. Investopedia notes indirect price influence via trading. In 2026, outflows pressure prices, but long-term, they attract institutions. Bloomberg analyst sees bullish structure. For beginners, this means easier entry, potentially higher prices over time. FAQs, answering common beginner questions. Q1, is it safe? Regulated but volatile. SEC warns of risks. Q2, taxes, capital gains like stocks. CoinGecko covers. Q3, better than direct BTC? For ease, yes. For control, no. Q4, 2026 outlook. Outflows now, but potential rebound. Yahoo Finance outlook. Q5, minimum investment. Shares start low, e.g. 2060. NerdWallet prices. Expand each Q with details. Analogies and examples. Making it relatable. Compare to gold ETFs. GLD holds gold, you get exposure without storage. Same for Bitcoin. Example. If BTC is $60,000, one IBIT share might represent 0.0005 BTC, priced accordingly. Historical. Like internet stocks in 90s, volatile but transformative. Advanced tips, beyond basics research fees, custodians. Watch for Ethereum ETFs too. SEC approved in 2024. Diversify with other assets. Conclusion and call to action. We've covered spot Bitcoin ETFs from A to Z. They're a beginner's bridge to crypto, despite 2026 challenges. Remember, invest wisely. For 100% true news and advice, like, subscribe to Joseph Markets, and comment your thoughts.